Portfolio Builder members, today's one of those days where you wish you were not listening to your editor and just going with the market movement. The SPY ETF is up higher. We made our guaranteed profit, but missed out on a lot of the upside. And this move in the S&P 500 is truly remarkable. And the higher we go, the more skeptical I become as the economic data around the world is really deteriorating. We have Christine Lagarde on TV talking about how worried she is about global growth slowing down, how there's no China deal inked yet. And until that happens, the central banks are very concerned. We've got housing bubbles in Australia and Canada that are starting to quickly deteriorate. And so I believe we have another potential crash in our hands, not a huge one like 2000 or 2008 at this point. But we have a very oddball situation where the TLT and the SPY have gone up in tandem almost. And this is highly unusual. Usually rates rise as equities go higher and vice versa. And although they may, in the long run, have been in a long-term bull market, about 30 years for the bond market, as well as the SPY, they just typically don't do that at once. So there's going to be a lot of risk parity funds who are having the best quarter in the last 50 years of running a equity bond leveraged portfolio. So there's a great chance that in the next month or two, there's going to be some serious profit taking and potential liquidity events that might test the last December lows. And so today's trade alert only earns a potential, if we go up from here at least, 0.17% return. Instead of going for the $100 156 times, when I'm fearful of the market, when I see over exuberance, when I see people being greedy, that's when we play defensive. And so if we grab $50 with our 100 shares of the SPY ETF, and we do it 156 times a year, and we only generate this tiny 0.17% return, which is what you can see is the return if we just increase our amount invested by $50 instead of our normal 100. You can see this is our usual goal to get a 0.35% return, but I've dropped that in half. And so you can see it still generates just under $10,000 a year of income playing it safe. So let's look at today's trade. And so if we scroll down, again, the demo we give you is if we can collect $100 doing a covered call 156 times a year, which you can do because it's the only ETF that has a option market with so many expirations, you can generate a huge return just from writing covered calls. And it's a great strategy for retirement, and it allows you to have a risk-free way to protect your assets. And so we spend a lot of time talking about the risks of this strategy. So today's a good example of how we're going to protect our portfolio, and last week as well. So we had to cover our position for a loss from Wednesday, but the underlying asset has skyrocketed. When we put on the trade, it was, I think, about $2.85, and now it's jumped up another $3.30. So while we lost about $1.70 on the covering of the covered call, we gained on the upside of the underlying asset. So our profits continue to grow, however, just not as quickly as people who were essentially gambling that the stock market's going to go higher and higher. Without a trade deal, with deteriorating economic data, and every central bank around the world telling us that they're scared a major slowdown or recession is ahead. And the bond market telling you that as well. So there's a lot of warning signs right now. So plenty of reasons to be cautious. This gives us about a $2.56 protection at the current levels, and can generate anywhere from $50 to $100 in the next 48 hours per covered call. So in the model portfolio, we have 17. In your portfolio, you may have less. And if we look at the option volume, we're betting against the speculators. They are pouring into option volume, playing the upside of the movement of the trend. And you can see there's a heavy skew today, buying that 288 call option that expires this Friday. So we have overrid the market and are just playing it safe. So let's talk about what happens. If we're right and the market goes flat or slightly down, we will be able to cover this position for a very handsome profit on the covered call that will be greater than any loss we've seen in the underlying asset over the same period. If the market jumps higher, we have a baked-in profit guaranteed. So let's look at what that is. If I zoom in on this, at this point in time, the SPY ETF is trading at 287.06, and we're agreeing to sell our shares for 285. That's a $2.06 loss per share. But meanwhile, we're collecting 256. So the profit baked into the cake, if we're wrong, is $50. And again, if we can make $50 3 times a week and protect our capital, that's still $10,000 a year of income, around a 33% year-over-year return, and that's amazing. That's something that we'll be very happy to do, and when everyone's being greedy, we're going to be fearful. That's the overall theme of today's message to you. On the TBT side, we can see it's already happening. The bond market is giving us a good clue. Yields dropped dramatically, sending the TLT much higher, and that gave some short-term relief to the stock market because bonds were so unattractive, unless you're a complete speculator, that it gave a big rally in U.S. equities. So what's going to happen next? Well, my expectation is that the TBT will trade higher, that the TLT, let's scroll up to that chart, I believe the TLT is about to have some serious profit taking. We've had all of the major hedge fund superstars, from Ray Dalio to Drunken Miller to everybody who's in the bond market, pushing the short duration bonds. Since last December, there's just been a huge push to buy these. And it worked. A huge amount of capital has been flowing in to the bond market. And now, and mostly that was just in a speculation, not that they wanted to make these tiny yields from the treasuries. It was really a speculation that the interest rate would continue to drop and that they would be able to flip these bonds for a huge profit. And so, of course, the folks who were buying these last year when the rates were really high have shown a huge profit. And they're probably starting to pull them off. And I believe we're going to see a sharp reversal in this TLT, which will lead towards a pullback in the SPY ETF. So currently, the poor man strategy is looking very good right now after seeing a pretty dramatic pullback in March due to this speculative rush into bonds. And so I think this is going to be a nice, steady, slow grind higher. The current trade alert for that is just right above the trading price. So unlike the SPY ETF, where we were writing the strike under the trading price, this one, we're looking to capture some upside movement in the underlying asset as well as the covered call. So we're currently in a position in our model portfolio, and we'll roll that over on Friday. But if you're wanting to just jump in now, you would purchase 100 shares or multiples of 100 and then sell to open the April 12th 34 call option. So that gives you 2 ways to make money on the TBT, whereas on the SPY, we're primarily hoping that it will go flat or slightly down from here to Friday. And if that happens, we can actually generate a profit greater than that $50 baked into the cake. Now, if we're wrong, it's okay. We still get that $50 and the SPY trades higher. Now, after covering the position and before writing the new covered call, our model portfolio has realized profits of $35,931 and was launched in the middle of the December Christmas massacre. So this has had to withstand some pretty serious drawdowns in the U.S. equities markets, which our portfolio was able to greatly reduce from the covered call. And then it was able to still generate a great profit during this remarkable rally, one of the best, I believe, since 1998. So the last time we've had this much market euphoria was right before the dot-com bubble. Of course, that was 2 years prior to the crash. So again, our strategy is to take the sting out of the volatility in the markets. We give up some of the upside, but that's not our goal. Our goal is to rent out the asset to speculators Monday, Wednesday, Friday, and generate a great return with a lot of protection to guard our assets. So now that we've written the new covered call, you'll see our return looks slightly inflated. It jumped from that 6.7 figure to 8.2. Let me zoom in on this so everybody can see it easier. And that's because we took the in-the-money covered call. So every update, I will take a snapshot of the track record prior to writing the new covered call. But right now we have a little bit of protection. So what happens next if we do see some serious downside movement? We essentially have 2 steps after the covered call to protect our assets. The first is to buy a call option on the VIX. So this could go down for a considerable longer time. We're not going to put on this position until the market really has a spike. And so to the downside. And that's because when you buy call options on the VIX, you really have a losing proposition almost all the time. And so if we look at the monthly view, we can see that volatility can be muted for months and even years at a time. So it's a very difficult position to put on. And we only want to do it when things get really hairy. We want to see some really fundamental bad news and the market reacting to it in a negative way. And that's when I will issue a 9% total portfolio position in the VIX. And most likely we'll have half of that position right around the trading price or below, and then a portion of it layered up in the out-of-the-money call options. So we're waiting for the market to actually show signs of weakness before we will enter into this position. The next thing we can do, which will be even more reluctant to put on, would be something relating to QQQ. So this is now almost back to highs, and this is a more volatile version of the S&P 500, which makes it a great way to short the market if we did think there was a crash ahead. So this would require a total breakdown in the China-US trade talks or some serious slowdown in US economic data before I'd want to put this on. But we can buy an out-of-the-money QQQ put option that goes into 2021 that's leveraged all the way to the $75 price. And those are trading at around 30 cents right now. So by the time we put that on, the market will have already pulled back considerably, and there will be some very troubling fundamental problems in the market that we don't see a way to quickly navigate through. In the short term, we will continue to collect the premium from writing the covered call and give ourselves a small amount of protection by doing this exact trade. So that's the plan for today. We will continue to slowly and gradually grow our account while playing it safe. And for those of you in our Tuesday class, don't forget Thursday, tomorrow, we have our emerging markets class. So if you want to get some exposure to Asia and primarily China's largest trading partners, then make sure to pay attention to tomorrow's Trade Alert. We have a webinar in 2 hours at 1 Eastern, and would love to have as many of you listening out there on the webinar with our community of investors. So thanks for your time, and look for a new update tomorrow.